Okay, so the Fed, they lowered rates once again. Rob, do you have any thoughts on this?
Well, I think what's becoming clear, at least more clear publicly, is the bifurcation within the Fed. If you listen to the comments, it seems very clear that we have on one side Chairman Powell and some of his um, voting sanction, if you will, who seem to believe, like we do, in the sort of traditional mandates of the Fed, which are stable prices and full employment. And what we've said many times, and what he seems to be reiterating, is that the data doesn't support easing monetary policy when you have 4.3% unemployment and 3.8% economic growth, quarterly economic growth, and inflation that's come down but still relatively sticky and above target. He's saying, maybe this isn't the best time to be lowering rates aggressively. Whereas on the other side, you have a segment of the Fed who has publicly addressed the what they call the neutral, or the rate of neutrality, which according to them, they should be setting monetary policy at a rate which is neither restrictive nor accommodative, and that's what they consider the neutral neutral rate to be. Excuse me. And they factor in economic growth. They factor in fact, they specifically mentioned the lack of fiscal spending. So they're actually looking at fiscal spending and economic growth, and it leads to a much more dovish stance because they think that policy right now is restrictive relative to where the neutral rate should be. So what's very clear, and what we've said many times, is that it's a very tricky situation because you have some data that's supporting lower interest rates, while you have some data that says, hey, we should be tightening here, or staying where we're at, because frankly, employment's pretty good, and prices are still a little higher than we expected, and economic growth is good. So, and couple that with the fact that the government shutdown has made the data inconsistent or incomplete, and it's a foggy situation. So, all that being said, I think that the market is expecting another cut this year, but on balance, probably less cuts in the future than what were priced in previously. So, and all that said, the Fed, it's important to remember that the Fed doesn't control the long end of the bond. All they control is short-term rates, and even that has there's some question about the efficacy of that as well. And maybe Phil, you could talk a little bit about. I know you have some insight on what you think the long end of the bond's doing and how it's sort of supporting what we've said.
Yeah, just to follow up on one thing, Rob, the uh, futures markets have priced in a 60% chance of a rate cut in December. It had been 95% chance up until the press conference last week. So um, Powell threw a little cold water on the prospects, but the market's still 60% odds of a cut. What we find interesting is that after every cut that the Fed has made starting a year ago, September, is that the long end of the bond market has sold off. In the first series of cuts a year ago, the 10-year sold off by 85 basis points. And, the media was promising everybody lower mortgage rates. Well, they went up 85 basis points as well. And same thing, this last cut last week, the 10 years up about 15 basis points from that announcement. Not 85, but still 15 over a week is a pretty decent move higher. So the market continues, as we've suggested all along, that the market is continuing to price in a higher inflation rate over the longer term.
Great, interesting. Now, brings up another good point. We are at 35 days of a government shutdown. That is tied for the longest one in history. Bob, do you have any thoughts on this?
Absolutely. And as we've mentioned before, we're very sympathetic to the workers, the contractors, and the military that's not getting paid during this whole process. Um, and at 35 to 35 on the tie, we don't know if we're in the first quarter or the fourth quarter. And there's no indication that we're closer to the fourth. So it leads one to believe that maybe we're in the first quarter of all this mess, and it continues to cause havoc on air travel. We've looked at some stats a couple different ways, and TSA screenings really haven't changed that much. But I think the delays that people are seeing after they get to the airport, many flights are delayed 3 or 4 hours, and some are completely canceled. So. Uh, uh, and the fact that there's not much government calculated data coming out, if any. And that's going to be hard for the markets to adjust to.
Yeah, one of the key things I think that is going to be interesting to watch is the tips calculation, because the Treasury has to accrete principal on trillions of dollars of tips that are outstanding. And if they don't have a solid number, nobody knows what accretion is going to happen on the tips.
Yeah, it's a big problem in a segment of the market that normally flows is pretty fluid, and potentially a big hiccup there.
So maybe they'll add 2%, and then we'll catch up with you later. Who knows?
Similarly, it's been incredibly difficult. We've missed the third quarter GDP announcement. It's been incredibly difficult to get a slew of government data that you rely on for economic forecasting and modeling and such. But I think it's important to note that in our discipline, we don't rely on economic forecasting or those types of things. We rely on the fundamentals and the earnings of the individual securities and the sectors that we're tracking. So it's important to have a discipline and stick to it, especially in times like this.
That brings up another great point. With our fundamental valuations and everything, we do put a decent amount of onus in market valuations. And I know that we've been talking about this for some times, that stock values are near all-time highs, if not at all-time highs. Phil, do you have anything more to add about what's been going on with these valuations?
Well, as everybody knows, the stock market indices that are cap weighted have become very concentrated, with a handful of large cap growth companies dominating the indices. They also dominate the valuations. Overall, S&P current forward PE is 22, which is pretty darn high. Warren Buffett's indicator of stock prices to gross economic value added is at an all-time high. So just about every fundamental valuation that you want to apply to the broad market indices is overvalued. And the only way that those can hold is if there's earnings develop to support those valuations, basically growing into the valuations. It's interesting to note that earnings for this year, for 25 versus 24, are currently forecasted at 12% growth. That had gotten down to almost 9% just 3 months ago. And of course, it started the year at 17. It's always optimistic at the beginning of the year, but it's improved just over the last month from, say, 9% growth to 12. So we're seeing some early signs of earnings improvement third quarter, which is unusual. And it could be the early signs of the earnings starting to grow into these higher multiples. But it's a little bit early to say. The valuations continue to diverge between the large cap tech. Margins have grown by 2% over the last, or since the first of the year in the Mag 7, and in the 493 remaining, margins have dropped 3% year to date. So, the divergence continues, not only in price domination, but in earnings domination, and everything's still pretty fully valued. The one interesting thing, and that is, if you look at price to free cash flow in the Mag 7, it's at 84 times, and that's indicative of the large capex that these companies have been putting out. The free cash flow has been heavily dented by these large capital expenditures, and we're now starting to see some debt issuance, $92 billion in the last month from these guys, which is the highest debt issuance in probably ever by this group of companies. Debt to EBITDA for the group is at 0.76, which is still pretty low. Once you get over 2, it starts to raise a question depending upon the sector. But at 0.76, it's pretty conservative. But you start adding $92 billion every month or 3 or 6, whatever their plan is. The debt levels are starting to rise. They're not at a unreasonable level, but they're starting to rise.
It's also, I wouldn't say it's safe to say, but you're starting to see some of that CapEx expenditure here in the third quarter being translated to earnings growth. I mean, you've seen some of those Mag 7, not only increase their make their earnings and increase their forecasted earnings, and in some cases doubling down or increasing their CapEx outlays for next year. So, what you would hope is that some of that CapEx eventually translates into earnings. And while we may just be at the beginning phases of that, perhaps that's a good harbinger of things to come.
Yeah, it is, but it's going to take some time. And I would say you're looking at a 2 to 3 year time frame before these companies can look back and say, these investments made sense because this is a return on these investments. It's just way too early in that process.
And I think it's also interesting to note, if you look at what some of these companies are spending, their CapEx expenditures are amongst each other. So in some ways, it's something of a game of musical chairs. We're buying storage here and chips here and et cetera, and sort of transferring money amongst each other in a big,
circular
Yeah.
financing.
That's great. Thank you all for your insights.